live from our studio in New York City. I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. An hour ahead of the close, and markets are charging toward new records as dozens of individual stocks hit multi-year highs, including FedEx. It reports after the close of trading. We're looking at the top movers and trending tickers.
And signs of hope in the real estate sector. Housing starts soaring to their highest level since May last month as mortgage rates extended their decline. The CEO of the National Association of Home Builders is here later this hour.
Plus, we've got the latest installment of the Investor Guide to 2024. Today, it's all about chips, and we're not talking just about NVIDIA. Find out what names you should be watching that might be flying under the radar. Let's get you up to speed on the market action right now as we take a look at stocks today that are indeed moving higher here. All three major averages getting a boost of about 0.5% each here, with the Dow once again trading at a record, right? If it has any gain, then it'll be another record for the index here. But the S&P and the Nasdaq are getting a little bit closer to those levels as well.
Yeah, I mean, listen, another day in the green here, Julie. So the Fed pivots and investors move in. That has been the bet. They're going to start cutting rates, and we can debate and discuss when that is and how deep the cuts will be. But that is giving risk assets a lift. And you see that not only in equities, of course, but you can look at it as Bitcoin as well. Many investors also betting, we know, that as rare and tricky as it is, that the Fed is going to actually be able to land this soft landing. And maybe some folks think the housing data you got this morning, maybe that kind of confirms their bias for the idea that, yes, it's rare, but Jay Powell pulled it off.
Right, exactly. So if we take this deeper dive into the markets here and look at kind of where we have come, the S&P 500 now approaching a record intraday high. The number to watch here, 4,818.62 for the S&P 500. It last was at that level back on January 3rd of 2022, or in a closing level, 47.9656. So that is the number to beat. Right now, we are above that closing record, I believe, at this moment. Oh, no, we're not quite there on the closing basis, but we're watching those levels here as potentially getting there. And if you take a look at the Wi-Fi Interactive, I have this two-year chart which shows that round trip that we have made for the S&P 500, where we have come back up to those levels but not quite breached the record. The Nasdaq Composite, meanwhile, hasn't made it back up quite to that same level time-wise, but still is at its highest since early 2022. And as I look at kind of what has pushed us higher here, it's interesting when you look at the year-to-date, or let's say 2 years, since we're looking at that 2-year round trip here. On the 2-year basis, it was energy that was leading, although as we know, energy has lagged this year. Then information technology, real estate was in the lagging position. And then year to date, it's been tech and communication services. As we know, the domination of the Magnificent Seven. Utilities have been in the weakest spot. But something interesting has happened over the past month, which is that we have seen a real broadening of participation in the rally. That's something our Josh Schaefer has written a bit about. And here, it's real estate that's actually done best over the past month because of the dip in interest rates.
Yeah, and that broadening out. Listen, if you're bullish on the market in 2024, that is part of your thesis, right? You're looking for you to move broaden out, expand. Your bet is maybe it won't be just about the Magnificent Seven. I mean, you talk about tech. That Magnificent Seven has had a stellar year. Although interestingly, we've talked to a number of strategists and we've asked them whether you push in to Magnificent Seven. Do you just go all in again in 2024? I haven't heard a lot of optimism about that, actually. I've heard more about either caution. I've heard a lot of small caps talk. That's been a big theme. So it's interesting where people are thinking about placing their bets.
Although I haven't necessarily heard people say to avoid it. And we have definitely heard some folks, like the Mark Mahaney's of the world, say Meta's going to continue to do well, for example. So the people who cover those industries closely, it doesn't sound like that they're pessimistic on the Mag 7 going into next year.
I haven't heard anybody saying they're going to short it. That's true.
That's true.
Yeah, no. The question is whether, do you think, listen, if you moved into those 7 stocks in January 2013, you're feeling pretty good and pretty smart right now. I think the journal pointed out, if you looked at those 7, they jumped like something 75% this year. It was a remarkable move. Basically left all 493 components in the SPX just in the dust. You're trying to place bets about whether you think that happens again in 2024.
So let's talk more about, get another view on all of this. So we, of course, also had the chorus of Fed speak continuing today, but the message about rate cuts isn't as straightforward. Our own Jennifer Schomburger sat down with Richmond Fed President Tom Barkin earlier. She is with us now. Give us the highlights, Jen.
Hey, Julie, that's right. Richmond Fed President Tom Barkin joining the chorus of Fed officials cautioning against those rate cuts for next year, telling me in an exclusive interview this morning that while the Fed has made good progress on inflation, he needs to see more consistency before responding with rate cuts. Barkin, who will be a voting member next year, says that the Fed is nicely positioned here, but stopped short of endorsing those rate cuts. Take a listen.
Well, if you're going to assume that inflation comes down nicely, then of course we'd respond appropriately. I've got a perspective that inflation is a little stubborner than I think the average person in there is in there, and I hope I'm wrong on that.
Barkin's comments coming after Fed Chair Jay Powell touched off a major rally in stocks and bonds with dovish comments at the FOMC meeting last Wednesday, saying that the thinking is that the central bank has done enough when it comes to hiking rates, and that cuts will be a topic of discussion for officials looking ahead. Of course, the median projection is for 3 rate cuts next year. But starting Friday, after the Fed's blackout period ended, officials started to clamp down on rate cut expectations. New York Fed President John Williams said the Fed isn't talking about cutting rates now. And even if they are, it's certainly not imminent. Atlanta Fed President Raphael Bostic told Reuters his thinking is more third quarter, and he doesn't see 3 cuts, but 2 next year. Come Monday, Chicago's Austin Goolsbee expressing surprise at the market's reaction and underscoring that the Fed is not pre-committing to cutting rates imminently anytime soon. Meanwhile, Cleveland's Loretta Mester also on Monday saying the focus isn't yet on cutting rates, more on how long to hold at current levels. That brings us back to today when Barkin told me that that policy is currently in a good place and he would need to see a wide breadth of prices continuing to drop before considering cutting. Guys?
Thanks, Jen. Appreciate it. And thanks for bringing us that interview.
Thanks.
Well, while stocks close in on records, our next guest isn't quite as optimistic for the broader market next year. His year-end target, 4750. That's below where we are right now. Joining us now is John Lynch, Comerica Wealth Management Chief Investment Officer. John, what strikes me is that it doesn't sound like, from reading your notes, that you're that pessimistic about the economy, right? So talk to me then about, and this is always a perennial discussion, the economy versus the market.
Thank you, Julie. Good afternoon. Yes, writing these reports is always very humbling, right? You do all the analysis in the first part of November, you get it published through Thanksgiving weekend, and you publish it right thereafter. And sure enough, the market goes up 12% over that time period. So I do believe that the equity market, I was looking at 8%-ish type profits and market growth next year. But we've run away. We've gotten way ahead of expectations, as you just discussed, with expectations on Fed rate cuts. I think the market's been a little too optimistic. I'm delighted to hear Fed officials starting to tamp down some of that enthusiasm. And you're absolutely right. I think we'll have fractional gains in the first half of the year economically, real GDP. And I think we stabilize in the second half of the year. So not necessarily a bearish outlook by any stretch of the imagination. However, the market has gotten ahead of itself and certainly gotten ahead of my forecast.
So, John, it mostly sounds to you like, correct me if I'm wrong, you're making a valuation call. You just think the good news has been priced in at these levels?
Absolutely, Josh. We're up 20%, 22% year to date on basically flat profits, right? So it's been a PE-driven market, and one of the themes of my 24 outlook was that the E must substantiate the P. And I think we need to accomplish that next year to really get a stronger foundation under the market. Clearly, over the last 6 weeks, we've had about a net 300 billion injection of liquidity into the markets. So that's consequently, weakened the dollar. It's pushed market interest rates down. It's certainly boosted equities as a result.
And where do you think, if we do get the growth in that E, where is it going to come from? You heard us just talking about the domination once again of the Magnificent Seven. are we going to see a broadening not just of participation, but also earnings growth from the market?
Yes, Julie, the broadening of participation is very important. One of the things I'm really pleased about with the market action over the last 6 weeks has been that the equal weighted index is starting to catch up to the cap weighted index. So I think that's a very important development. So A, you have broadening. B, specific to your question, communication services really needs to deliver on that 50% gain year to date, right? They need to deliver from a profit standpoint. I think you'll need to see that on the technology space. I am looking at, almost a barbell strategy, if you will, healthcare, which will have some growth, good earnings growth, and also for anyone concerned about interest rate sensitivity, not necessarily affected there. And then the industrial space has been quietly firming all year on a relative basis to the S&P 500. And I think I think that group is set the stage, if you will, for strong profits given, the Inflation Reduction Act, given infrastructure spending, and to the degree that global growth stabilizes as we suspect it will.
And John, as you look ahead at 2024 and you're surveying the stock market, what are the big risks that you see out there, John, that you think investors need to be aware of? Are you watching the Fed, the economy? Is it the election, geopolitical risk?
Well, I'm afraid geopolitical risk. I think when I look at this optimism that has proliferated throughout the market, don't want to be a total buzzkill, but we've got war on 2 continents and tankers can't get through the Red Sea. So it's still a very dangerous situation. And I think optimism and sentiment can shift on a dime. I'm surprised to see put call ratio so low, the VIX so low, given what we're seeing geopolitically. So that's my first concern. Second concern is, I'll call it a misguided response to Fed messaging. I'm hard pressed to see 5 or 6 rate cuts next year, if, as the consensus is suggesting, if consensus is also suggesting 12% profit growth and 5% revenue growth. You can't have both. If the Fed's going to cut 6 times, it's because the Fed has to cut 6 times. And I don't think we want to experience that sort of drop in economic activity in the first half of the year. We're still looking for fractional growth, 2 cuts, maybe 3 in the second half of the year. But I think the geopolitics and a misunderstanding of the Fed's messaging are the 2 big risks for next year.
So Fed and geopolitics, John, I'm also curious though, are you watching the election as well? That's another variable as a strategist.
Oh, yeah.
How are you thinking about that?
Oh, it's great, palace intrigue, right, for all investors and what any proposed legislation could mean. So we're paying very close attention to it. But unfortunately, in the absence of really data, you just have to look at the charts. And typically you see in a presidential re-election year, you typically see the market pull back a bit in the first quarter as we're going through primary season. Then you tend to stabilize going into the summer months when you have the conventions. And that's when you get the platform. And that's when fundamental analysis really can help determine what policy, what legislation, how that can impact economic or market activity. And then if President Biden is going to be reelected, typically you see the market perform well in September and October. If it's not, it would suggest the opponent could win.
John, it was great having you on the show today, sir. Thank you so much for joining us.
Thank you. My pleasure. Be well.
Let's get into some trending tickers in today's trade. Check out shares of a firm. They are soaring today, up about 17%. Company announcing it will bring its pay over time option to self-checkout kiosks at over 4,500 Walmart stores across the U.S. So that was the news today, Julie. I mean, basically, the news here, a firm really expanding its reach with more potential consumers. This stock, by the way, is now up some 400% this year. So just a remarkable move for Max Levchin's company. Perhaps not a big surprise after a move like that. You've got about 45% of analysts covering a firm. They're now on the sidelines with a hold. There are still some believers, though. I checked in with Dan Dolev over at Mizuho, friend of Yahoo Finance. Dan has been pounding the table on a firm for a while. Continues, he says, to have a buy on this name. Says it still enjoys just a small penetration of what he thinks is just this massive TAM. Likes the product innovation adoption, he says. Likes the Affirm card. Thinks they can double GMV over the medium term. His target's 30.
On the flip side, you've got James Faucette over at Morgan Stanley, who downgraded the stock just yesterday, I believe, and basically said, You know, it's not necessarily, and as you pointed out, there are more holds than buys on the stock right now. It's not necessarily because people don't believe in the fundamental story. It's because of that 400%
yeah, that'll do it.
Rally that the stock has had this year. And that's what Fawcett said, that the valuation is just, you can't justify it given the outlook for the company. So yes, of course, it's up today, another big pop. All those guys might be wrong. Valuation doesn't matter if people keep buying, right? So we'll see what ends up happening.
431% in 2023. Not bad.
Not so bad. Let's talk about another rally that we've seen this year. That is in Bitcoin. We are seeing it up again today, 1.6%. Year to date, it's up over 150%. And there are some potential catalysts here. Investors are betting on Fed rate cuts. They're hopeful also, of course, the Securities and Exchange Commission will soon approve the first spot Bitcoin ETF. A couple of other things that are out there here. We have been seeing more inflows into crypto exchanges. CoinDesk citing some data from Into the Block and saying that it saw $860 million of net inflows into exchanges last week, which is the highest level since March. Now, on the flip side, they said when people move their assets to exchanges from, say, cold storage perhaps, that might mean they want to sell. So that could be maybe a little bit of a bearish counter indicator because Bitcoin's done so well, and coming into the end of the year, maybe people want to start taking some profits.
Yeah, I mean, a couple of big things. One is the expectation that the Fed's going to cut rates, so that obviously supports risk-sensitive assets, stocks, crypto. Two, the expectation is still out there, Julie, we've talked so much about this, that the SEC is really going to approve that spot Bitcoin ETF. And there's been, listen, plenty of heavy hitters. Can't wait to sell you that product. So BlackRock, Invesco. And we've had this kind of conversation with a lot of smart folks about whether that really is a catalyst for Bitcoin into 2024. There was a good note from the team at JP Morgan saying just that, arguing actually kind of cautious on crypto markets next year, see a high chance of buy the rumor, sell the fact, they're telling clients, once that SEC does approve spot Bitcoin ETF. So we'll see how it shakes out.
Yeah, and there's also some evidence, by the way, that retail investors have not been getting in, or at least not getting in anew to this group. If you look at app downloads, which is something that some of the journalists out there have been doing, we have not seen the kind of downloads of Bitcoin or crypto buying apps that we saw during the past boom cycles, but maybe that's because people bought it and now they're hanging on to it. It's difficult to say.
So what a move. I mean, Bitcoin up somewhat, 150% this year. Tremendous. Finally, let's check out Chewy, rising today. That says Jefferies initiates coverage on that stock with a buy rating. You can see up about 8% on that news. So it has not been a good year if you've been long Chewy. The stock has been under real pressure. It's down about 40%, Julie, but that can mean, obviously, when that happens, risk reward can start looking more attractive. And that's what the team at Jefferies in part is saying here. They initiate coverage with a buy. Their target is 27. And they say, listen, this is a pure play on pet e-commerce. They see several growth and margin levers ahead, pet health, ads biz. And an interesting kind of macro point they made too, which is that, listen, we know some consumers are under pressure. Maybe they're not buying food and discretionary as much as they were, but they know that Chewy indexes to high income groups. So maybe kind of sheltered from that in some sense.
Okay, and at the same time, Pet IQ, also a buy. I don't even know what Pet IQ is.
I don't know what Pet IQ is.
And Fresh Pet Bark and Petco are hold.
Yeah. Do you shop for Sparky at Chewy?
No.
You don't?
No,
Where do you go?
I usually just go to Amazon.
Same here.
Yeah, or because
Maybe we're missing out. I don't know.
I don't think so. We're just getting started here on Yahoo Finance Live. Coming up, a new installment of our series of Goodbye or Goodbye. We're going to look at the AI space and tell you which pure AI play is a buy right now. Also, FedEx second quarter earnings after the bell. We're going to break the numbers and give you in-depth analysis of that report. Plus, after the break, we'll bring you an investor guide to the new year around the semiconductor space. All that and more when Yahoo Finance returns. Google's big payout. The tech giant will have to shell out $700 million to settle an antitrust lawsuit around its App Store practices. The company will also have to make some changes to allow for more competition in Google's Play Store. Here with the details of the settlement, Yahoo Finance's Dan Howley. So Dan, how exactly is this going to work?
Yeah, this is a lawsuit that was brought by dozens of state attorneys general, and they, in addition to that sum, which is admittedly paltry compared to what Alphabet brings in on a quarterly basis, they do have to make some significant changes to their business practices, and that's where kind of the rubber hits the road almost with this case. So three of the changes that stand out in particular include the fact that Google, for the next 5 years, has to let companies tell users where they can get better prices on apps outside of the Play Store. So if a company is going to be able to offer something for less money than it would otherwise on the App Store because of that 30% tax that Google levies against them, then they have to be able to tell consumers that. Google can't prevent them from doing so. Google also can't stop companies from explaining to users that they might have to pay more if they buy through Google due to those fees. So that's another thing that's going to be going on there. And Google has to let companies give users the option to purchase apps through a service other than Google's own payment processing service. So right now, if you go to Google and you try to purchase something, you're going to pull up Google's own payment purchasing system. For the next 5 years, Google has to allow app developers to offer their own payment system. So that would kind of circumvent the issues of that 30% fee if they don't have to go through Google's system. And so this really is kind of the crux of the argument that a lot of app developers have had is, we would offer our services for cheaper, but Google and on the other side of the aisle, Apple are taking 30% or 15% of our revenue. And so we need to raise the prices on that.
This kind of goes. I'm sorry, go ahead, Dan.
No, after you.
I just want to switch gears here, Dan, talk to Apple as well. Apple looking to avoid this watch ban on the Series 9 and Ultra 2 coming out of that patent dispute. What is the latest there?
Yeah, so right now they're still in kind of a holding pattern, trying to see whether or not the Biden administration will actually intervene and veto these two orders, the cease and desist order and the exclusion order, the limited exclusion order from the International Trade Commission. They don't know whether or not they're going to do that, but right now Apple is preparing for the worst, that Biden administration will not move ahead with anything and that they will have to pull the Apple Watch Series 9 and Apple Watch Ultra 2 from store shelves, online and physical. Third-party sellers, they can still sell those watches. Best Buy, Amazon, if they're there, they're there. But Apple itself won't be able to sell them if the Biden administration doesn't move forward, or if Apple doesn't reach some kind of agreement with Massimo, the company that owns the patents that were infringed upon, or they don't make some kind of software change that can satisfy the company as well as the Trade Commission. So we just have to see where that goes. But as of right now, it's looking like the 21st and the 24th, they'll stop selling the watches in store and online.
All right, it's a big fight. Investors and consumers are going to keep watching. Dan Howley, thank you so much, sir. Meanwhile, artificial intelligence has been the biggest story of the year and the biggest market mover, too. It has been the catalyst that has led the indexes to end this year on a high, with semiconductors laying the foundations for this tech to become a reality. Largest of them, NVIDIA, is up more than 240% year to date. It was clearly the biggest play this year, but what will be the next? To help answer that, we turn to Stifel's applied technology analyst Ruben Roy as part of our investor guide to 2024. Ruben, it is great to see you. Let me ask you this, Ruben. So you're looking at the SMH here, so the ETF that tracks the chips. It's up about 70% as we round up 2023. Ruben, when you look ahead now to 2024 for chip investors who are listening, Ruben, what are the big bogeys, the big lessons you want to see in 2024? What's going to be the one big thing that's going to move this sector? And I don't mean to pigeonhole you. Maybe there's a couple, Ruben.
Yeah, hey, nice to see you here, Josh, on Yahoo, and thanks for having me. Yeah, it's a broad question, right? Semiconductor industry has a lot of moving parts and a lot of different types of companies that do a lot of different things. And you point out the SMH. A lot of the SMH move came from a handful of companies this year in 2023. One of the trends that we identified way back in January of this year, we do a trends report, was, AI and a couple of the companies that we thought were going to benefit. And certainly NVIDIA came out and, starting with their earnings back in the spring, really started to surprise us. So we've seen that sort of flow through the NVIDIA model. We think there's still plenty of room ahead. These semiconductor companies are now transitioning into not just being semiconductor companies. We think NVIDIA is one of the first semiconductor companies that's cracked the code on becoming a software and services company. And so I think that's going to start to play in the model as you look out to 24. And if I had to, think about, some of these themes and trends that investors should be looking at, it's just that, what's next for AI? We've got these big investments, capital investments from all of the big cloud service providers going into building out these massive training clusters. What happens next with the training clusters? How do you make an ROI on those investments? And I think that a lot of that is going to come back to, software services, moving this infrastructure and technology over to enterprise, customers. And I think we're going to start to see that play out. And certainly NVIDIA, in our view, still screens as the best way to play that move. I think there'll be other companies that get involved. We like AMD, and we've talked about that in a few recent research reports. AMD had an AI specific analyst event a few weeks back and talked about their new hardware, but also, kind of this concept of AI being a three-pronged, technology approach for these companies, which includes networking, software, and the hardware itself. So I think, that's where investors should be looking. And I think AI is still going to be the big theme when we look ahead to 24.
I feel like so much of the conversation, Ruben, is around NVIDIA and AMD for that matter. Are there some within the semiconductor space that are perhaps less well known that maybe investors should be looking to, particularly that can play that sort of 360 approach that you're talking about?
Yeah, and that's a great question. And that's something that we've been doing a lot of work here, the tech team at Stifel, trying to figure out where the puck's going around AI, right? Because again, as I mentioned, these are tens of thousands of GPUs being built into big clusters, and there's networking aspects to it. But today, a lot of that networking is run by NVIDIA. If you look at NVIDIA's networking revenues, which, you compare that to a company like Broadcom that does networking chips, or a Marvell that does networking chips, NVIDIA all of a sudden is on a $10 billion annual run rate, which is networking, which really is a much smaller business for them, even a year ago. So when we start to think about what happens with AI networks and the rest of the data center, we look at companies that are involved in, putting the front ends of the networks in the data centers together, connecting data centers together, that are being built separately because there's just not enough power to power these data centers. So on that, kind of front, there are technology companies that we follow. Coherent is one that comes to mind. Lumentum. These are companies that are doing optical components, lasers, transceivers, and things like that live in the data center. So a little bit further along the food chain, but certainly I think there's a lot of revenue opportunity coming as the rest of these networks get built out again to monetize the big capital infrastructure spend that has happened for the training clusters thus far.
And Ruben, another theme, and I think you can bet it's going to play out in 2024 too, is just this increasing tension between Washington and Beijing, Ruben. It doesn't look like Washington wants to, limit the export of more mature tech, but they're certainly, of course, putting these export controls on more advanced chips. I'm just wondering, Ruben, for chip investors who are listening, how should they think about that tension? And does that disruption, Ruben, does it perhaps create opportunities for investors?
Yeah, so that's an interesting one. So we cover Intel. We have a hold rating on Intel, but there's obviously a lot going on at Intel and a lot of interesting, positive, momentum at that company. We still think it's sort of a show don't tell story, but to the extent that, we think it's absolutely imperative for a lot of these companies that are very dependent on Taiwanese manufacturing and assembly plants to think about a reshoring or onshoring strategy. And to that end, Intel is putting together, kind of a massive strategy towards bringing back leading edge semiconductor manufacturing technology and infrastructure back to the United States. The issue is that this is going to take time. And, these are very complicated technologies. There's a lot of moving parts in bringing in equipment and actually executing to these plans. And so a little bit longer term in nature, but investors should be, watching that as well. If this were to go well, 2, 3, 4 years down the road, Intel is certainly one of the companies that stands to benefit if they are able to execute on their strategy. For our fabless design companies, we think it's absolutely going to be something that they'll have to consider. Again, will take some time. You flashed up a few of the design companies that we follow, Cadence and Synopsys. Our view is that those types of companies that are creating software and a lot of the tools at the front end of the design process are going to benefit, because they're sort of like arms dealers into sort of this overall manufacturing supply chain. And to the extent that we do have more manufacturers here in the United States, they are absolutely going to partner with those companies like an Intel or others. And so we think there are different ways to play it, and something that investors should keep an eye on. Again, it's going to take a little bit of longer term to play out on that front.
Ruben, it's always great to get some time with you. We really appreciate your insight and lots of good ideas going into 2024. Thanks again, and happy holidays.
Happy holidays to you. Thanks for having me.
Thanks. Coming up, a new installment of our series, Goodbye or Goodbye. We're going to look at the AI space from another perspective and tell you which pure AI play is a buy right now. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye, brought to you by E-Trade from Morgan Stanley. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're looking at the buzziest topic of the year, artificial intelligence. We'll discuss how to play the space with one sure bet today and one that maybe has some promise down the line, but maybe not quite yet. I'm here with Defiance ETF CEO and CIO Sylvia Jablonski. Sylvia, great to see you in this capacity. Welcome to Goodbye or Goodbye. I feel like it's a game show when I say it like that. But obviously we're talking about some good ideas here for investors. So let's talk about first your Goodbye, and that is Alphabet within AI here. Let's go through your investment case. Obviously, looking at the past year of chart, it has already done quite well. But it's still, according to your first point here, cheaper than the other Mag 7 stocks.
Yes, and great to be here. This is a lot of fun. So I love Alphabet. I think it is actually one of the cheapest Mag 7 stocks now. So it's trading at a multiple of about 25 versus an average of 41. And they're touching so many different areas. So when you think of Google and what they're going to do, you have YouTube, you have Android, you have ad sales, you have generative AI with the Gemini announcement recently, and also quantum computing. So they touch a lot of awesome spots. So you have Gemini AI revenue potential up there. So we know that Microsoft kind of came blazing, all forces go, and they kind of won the race this year for 2023. I think that arguably Google is going to catch up next year and sort of take over. And because they lead in ad sales, they can use their generative AI bots to help with customer service, to help craft better ads, and essentially capture their already existing audience and generate revenue potential from AI.
Yeah, I think that's a really interesting point about all of the different areas and lines of business that Alphabet touches where this could be an effect. And we're talking about a big market. I mean, all of the estimates that are out there are very lofty in terms of how big AI is going to be.
Yes, and so if we think about AI having a CAGR of 20% or so for the next 5 to 10 years.
Compound annual growth rate.
Compound annual
for those
growth
who don't
rate,
know.
yes, in the next 5 to 10 years. That's a massive opportunity, but actually the $2 trillion that I refer to here is for the cloud business. So they had 23% year-over-year growth in cloud. They're behind Amazon and Microsoft, but they're certainly catching up. And if you think about all of this, with all of the data and storage, we often talk about AI, and it's just kind of like this one word that we all focus on, but you need supercomputers, you need quantum computers, you need cloud services, you need cybersecurity. And so Google, again, plays in that space. And I think the cloud playing in that $2 trillion will help the company grow.
Yeah, that's something we were just talking about with the semiconductor analyst, actually, all of the training power and chips, and that then speaks to the cloud also that's going to be necessary to power all of that activity.
Exactly.
All right, let's talk about a potential risk, though, for Alphabet and to the upside for the stock. Or actually, you've listed a couple of them for us here. And that one of them is that Gemini doesn't work out how they want.
Yeah, and these debuts have been super interesting because some of them are shock and awe, and then all of a sudden you go back and kind of review how they set the AI tool to work and respond to the particular question. It's like, it leaves you wanting a little bit more. But any of these AI bots or generative AI technologies could actually fail. If they do fail, that's, and they kind of fall below Microsoft again and fall below Amazon again and whoever it might be, that's an overhang. Macro, just uncertainty. I don't necessarily think this is going to happen, but if we're worried about a recession, if we're worried about any change in the inflation game here, then companies spend less, essentially. But 70% of the S&P 500 companies apparently are already using some of Google's cloud services. So if they can capture that group for AI, that's a great opportunity too. And the less business spending would go with the macro overhang.
Yeah, it would be difficult to see, though, if you already have cloud spending pulling back.
Yeah.
If you're using that capacity, I guess, unless your clients don't need it or something along those lines. Before we move on to your Goodbye, do you hold Alphabet?
I do hold Alphabet.
Okay, so you have a position Alphabet. Now let's get to your Goodbye, what you're saying farewell to. And this one is Adobe, which is an interesting one for multiple reasons, not least of which is that it canceled a big acquisition this week. But we'll get to that. First of all, the company recently came out with an outlook, and you and many other folks found it underwhelming.
Yeah, so in their last earnings announcement was actually really good. You know, they were up kind of 10 to 12% in different categories year over year in their services. They're arguably one of the leaders in creative software technology, but their outlook was sort of left a lot to be desired. I think they came in at about 21.33 billion. The street was expecting about 21.73 billion. And you know, they haven't really monetized AI to the extent that they're talking about AI. So, you know, we sort of want to see a little more growth, I think. And by the way, I'm not sort of like picking on this stock, because that last chart that you showed is phenomenal, right?
Yeah.
This is like it's not like goodbye because you're terrible. It's like goodbye, take your gains, right? And put them somewhere else. So it's,
I like that,
you know.
a different spin on goodbye.
Yes.
Well, let's talk about another catalyst that happened for the stock, is that the company canceled its acquisition of Figma. Now, you could argue strategically there's fallout. There's also the fact that it's going to have to pay $1 billion breakup fee for that, or canceled merger fee.
Yes. So, you know, there's two ways to look at this. One, they free up that, you know, that money, that $20 billion, but they lost $400 million of potential revenue. They have to pay that $1 billion fee. And I think that they're just, you know, and they also wanted to kind of take over to wipe out one of their competitors, right? So I just think that there's going to be some noise with that $1 billion fee. I think that they're going to have to sort of shake things out and refocus what their plan is to fully develop their AI technology because of this. And so 2024, I think, is going to be a shakeout year for them. And then I think, you know, 25, 26 going forward, growth potentially continues. But near term, I think they've kind of hit their peak. And valuation wise, we're talking about 52 versus Google's.
Gotcha.
25.
All right, and there's one more thing you're watching, and that's what insiders are doing. And there's a chart that you brought us that shows the insider sales. We've seen the likes of CEO Shantanu Narayan, who's been among the folks who's been selling shares.
Yeah, and so there's two ways to look at this too, right? So I think a lot of times insiders sell because the stock price is really high, right? And they're trying to generate their own profits and income and things like that. But if you kind of look at this graph here, there's just been like a consistent level of selling through the last year or so. And I just think that oftentimes insiders, they're closest to the business and they kind of know something. So I do think that, you know, maybe that the lack of confidence from insiders is telling of a potential, you know, thing to look at anyway.
Well, something to be aware of, certainly, when we look at that. And then what would be the risk? What could end up going well for them in 2024?
Yeah, so I think, you know, I think that they are the leader in creative software. So I think if they don't have any issues with the FTC about subscriptions, they have these super expensive subscriptions, they have a captive audience. And so then if they roll out the generative AI, I do think that they can expand on the revenues they already have. They can take that $20 billion and put it into Firefly. They can put it into trying to capture a larger audience. You know, they're going to have to kind of fight against Microsoft Paint, which is now going to be another generative AI software. So but overall, look, their margins are good. Their balance sheet is good. It's a well-run company. It's hard to argue that, you know, they're going to fall off of a cliff here.
And do you have any position in Adobe?
I do not.
Okay. All right, Sylvia, let's sum up what you have told us today. So your buys Alphabet, you're bullish because it's cheaper than the other Magnificent Seven stocks, and you see AI revenue potential from Gemini and projected growth at $2 trillion in the next decade, particularly when we're looking at the cloud engine for Alphabet. And your good buy is Adobe, at least in the near term. You do see some headwinds in 2024, an underwhelming outlook, $1 billion payment to Figma because the merger did not go through, and you're seeing insiders sell the stock. So that's to sum up. Sylvia Jablonski, thanks so much.
Thank you for having me.
Really appreciate it. That does it for Goodbye or Goodbye. We're going to be bringing you new episodes 3 times a week at 3:30 p.m. Eastern. We'll be right back. The market assuming the Fed is nailing the soft landing, but some data show that the Fed's fight against inflation is not over yet. Jared Blickery is here with the details. Hey, Jared.
Hey, Julie, and assumptions are not always the best thing here. Always check them. Here is a chart, and I'm going to begin with this, what investors expect the Fed funds rate to do throughout next year. So this tracks 2024 and actually ends on the first month of 2025 in January. Now, as of October 31st, this cyan line is showing that we were expecting some rate cuts. And in fact, the terminal rate at the end of January for this particular time, it was 7 weeks ago, was about 4.5% or so. Now, shift a few weeks later, and a lot more rate cuts have gotten priced in. The Fed has pivoted last week, but there's a little bit of a problem because we still have inflation, and some of the Fed's preferred metrics here are actually stuck above 5%, and that would be core services ex housing, and that includes things like healthcare and hospitality and rent of shelter. These are 3-month annualized, so these are going to show a little bit different picture than you will the year-over-year numbers that we typically look at, or just the month-to-month numbers. But I think it's instructive that these are actually pointing upwards a little bit, so that trend is in the wrong direction. And it was only earlier today that Atlanta Fed President Raphael Bostic was speaking with Yahoo Finance's Jen Schonberger, and he was saying the battle against inflation is not done. And this is being echoed by a lot of other Fed members, from Chicago Fed's Goolsbee to Mary Daly and a bunch of others. And only today, we did get the latest survey from the Bank of America. This is their Global Fund Manager survey. 66% expect a soft landing. Only about 23% expect a hard landing, and 6%, well, 6% is a no landing camp, but that no landing is actually a danger to the economy, because that is where the economy accelerates and it gets away from the Fed once again without ever touching down. So I'm writing about this in the morning brief tomorrow, and it seems to be probably one of the lesser, I would say, far out there risks of 2024, that in fact we don't get a landing.
All right, Jared, I'll be looking out for that article. Thank you, sir. Lots of new housing data out today, possibly laying a strong foundation for home builders. Housing starts hitting a 6-month high and coming in higher than expected. Builder sentiment is up in December as mortgage rates come down, according to the National Association of Home Builders. Joining me now is NAHB CEO Jim Tobin. Jim, it is great to see you. A stat that obviously stands out: new home construction soaring, Jim, nearly 15% in November. You know, Jim, I look at the 30-year fixed. We're at 6.64%. Certainly better than where we were. But if you're locked in at 3%, Jim, that's not getting you to move. If I was at 3%, I wouldn't be going anywhere either. So I would expect inventory stays pretty limited here, Jim. I mean, the backdrop seems pretty constructive for home builders as we head into 2024. What do you think?
I think you're absolutely right. At the end of the day, new homes are the only game in town because of that rate lock. And as much as we are thrilled to see rates retreat from 8, if not in 7.5%, and get down into that 6% range, you do have a lot of homeowners sitting in 3 or 4% mortgages, and they're not going to be ready to move yet. Which again, that gives us an opportunity to start building to capacity. And more importantly, starting building to demand and making new homes really the only game in town if you're in the market to buy a home right now.
And Jim, so look ahead to 2024. What kind of growth do you see for your industry, Jim? Can you quantify it for us? And I'm also interested, what kind of homes do you think are to be in demand?
Well, we're predicting a 4 or 5% increase in home construction next year, and that is largely due to what we believe will be continuing falling rates. Just last week, the Federal Reserve not only talked about no more rate hikes, but they've actually telegraphed 3 rate decreases in 2024. That's one more than we had forecast. So we're really looking to accelerate into the second half of 2024 with home construction. But when I think about where we're headed, I really think that it's going to be on that moderate-sized home. We have seen home sizes, square footage trend downward as interest rates have crept up. So as interest rates are still, they're historically low, but for over the last 10 years, they're higher than they have been. I do think we're going to see a trend to smaller homes that help people afford home ownership.
And Jim, as you look across the country right now, when you look at activity, where are the hot spots, Jim, regionally right now?
Well, it's in your high growth states, which has traditionally been the Southeast. And I'll throw Texas into there, even though they're a little bit more west, obviously. But Florida, the Carolinas, Alabama, and Texas. And then you start working your way into the Nevadas and the Arizonas, of course. Those are really been the hotbed of construction across the nation over the last several years. Remodeling, that is going to be in your older states like New England or the upper Midwest. You're going to see remodeling activity, a more important capacity there.
And Jim, so we talked about these tailwinds for your industry. Let's talk about some potential challenges as well. I'm really curious, Jim, to find out about labor. Are home builders right now, are they able to find and hire all the workers they need?
No, for the past decade, we have been consistently underemployed in the construction sector. Usually month over month, according to federal government data, we're about 400 workers short in the construction industry, which of course just delays home construction, but also adds to the cost of labor. So for us, it's about getting more youth into an aging workforce and getting more parents pointing to their kids to the trades is a great career in America where you can earn a good living and you can help build the American dream. That's one of our headwinds. The other big one is the availability of lots. As home building gets going, land availability will get more scarce. We need local governments to really step up and help us meet demand in home construction by making sure that they are opening up affordable pieces of land for us to develop. And then finally, the last piece, the big headwind we're worried about is if we do start accelerating into 24 and then really pick up in 25, are the supply chains fully healed from the pandemic, or are we going to see a spike in gypsum and wallboard? Are we going to see a spike in lumber and copper, those critical building materials that help us build an affordable product? And then, obviously that brings inflation back into the equation. So while we feel some tailwinds with rate cuts coming, we are mindful of some of the headwinds out there ahead of us.
And Jim, I want to get you out of here with a question on politics. I know you all had a strong relationship with Speaker McCarthy. You've talked about that. What is the relationship like, Jim, with Speaker Mike Johnson?
Well, we have a great relationship with Mike Johnson. Our builders are very close to him from Louisiana. So we've already established a really good working relationship on some key issues, including labor issues and housing policy issues moving forward. We're mindful of a tax bill that could be moving in the first part of next year, where we have some priorities potentially there as well. So we have engaged with the new speaker and his team, and we are really optimistic about continuing a great relationship that helps move housing forward for all Americans.
Jim, always love having you on, sir. Thank you for your time and insight today. We appreciate it.
Thank you.
And coming up, closing bell on Wall Street, we're checking in on the latest market moves and the top trending tickers. Stay tuned.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
We're coming up on the closing bell on Wall Street, so let's check on where we are headed here. Continued momentum, it feels like, appetite for risk assets as I see the likes of ARK trending on our trending tickers page. Of course, Kathy Wood's ETF that sort of is synonymous with that sort of game on kind of
Risk
vibe,
on.
right?
That's
yeah,
definite.
I mean,
Yeah,
it feels
for
like
sure.
it, right? So when you look at what we're seeing in the major averages here, the Dow and the Nasdaq up about 0.6%, the S&P up about 0.5%. But it does feel like ever since we got what was seen as a pivot from Jay Powell, despite the fact that we've gotten a lot of other Fed speak coming out trying to offer more nuance, it doesn't feel like the market has read those initial comments much differently than they originally did.
Yeah, I mean, you're totally right. I mean, we have heard from different policymakers who've come on and maybe sort of pushing back a little bit, throwing a little cold water, but to your point, all I see is more green across the screen today, looking right through that.
Green across the screen. And we're also seeing other assets on the rise, right? We're seeing, again, another day of outperformance for the small caps in the form of the Russell 2000. We are seeing crude oil move up. But gold's also moving up, so go figure. It's not like people are looking for safety here. And we are seeing some buying in the bond market as well. That's sending yields a little bit lower here today, though still they've been creeping back up towards 4%.
All right.
And there we got the closing bell on this Tuesday here as we see again some of this upward momentum is indeed continuing on the day. Everybody ringing those bells. And what's interesting here, we were talking at the top of the show about the S&P 500 getting back towards its record. The Nasdaq 100 has made it there. The S&P is not quite there on either an intraday or on a closing basis, but lots of individual stocks have made it there, or at least have made it to multi-year highs, which is what we're seeing for the S&P as well. Caterpillar is one of those that's at a record high today. Wasn't necessarily anything going on with CAT specifically, but just this momentum that we have seen. And then we've been talking a lot about the rally broadening out beyond the Magnificent Seven, but the Magnificent Seven are also still going up, right? It's not that it's or, it's and. So Meta trading at the highest since September of 2021. Netflix, although I guess it's not in the Mag 7, but it's in the FANGs, right? If we're going back to that older moniker. Netflix at its highest since January 2022. Amazon its highest since April 2022. So a lot of examples like that. Amazon touching that level today, but finishing the day a little bit lower.
Yeah, the bias just seems to hit the buy button right now, and it's hard to see how that changes. I mean, obviously you watch the news flow. We do have some more important economic data on tap. We got the Fed's preferred inflation gauge, I believe, on Friday.
Yes.
So maybe that shifts it, but right now we just continue to drift higher.
We do. So nothing, we'll see if that does change the narrative on Friday. Let's talk about some other trending tickers we're watching. One of them is Lyft. Those shares in the red, but very slightly, actually coming back quite a bit, or actually that's the extended hours. So in the regular session that we saw for Lyft here today, we did see, I believe, a dip of about 3.6%. And that's because there was some selling going on here. According to filings, co-founder John Zimmer sold about $3.5 million worth of shares, and the president of the company also selling a much smaller chunk of shares. Now, these kinds of sales happen for all kinds of different reasons.
Correct. Yep.
You know, you could say, I guess, that maybe there was a little profit taking. Lyft up around 36% year to date. Maybe that was why. But still, you tend to see sometimes this trigger a little bit of selling when this happens.
To your point, I mean, despite the drop today, this stock is up nearly 40% this year. It has been a really strong year for Lyft. Dow Jones actually noting it is on pace here for its best year on record, actually. Not a ton of support on the street, right? Most are at a hold who cover the name. But we did recently speak with Lyft CEO David Risher here on Yahoo Finance, and sounding very confident, very optimistic to talk to us about the company's focus. Talked about their focus on rideshare, 100% concentrating just riders and drivers, obviously trying to point a differentiation with Uber as well, but very strong year. If you were long Lyft in January 2023, you're pretty happy.
Well, but you might be happier if you
That's
owned
true.
Uber,
It has been
because it was up 150%
rocket
this
ship.
year.
And they're different on the street too. I mean,
Yeah.
analysts pound the table for Uber, so it is different.
So kind of it's all relative. It always is, right?
Right.
Yeah.
All right, finally, here's another name for you. Fuel Cell Energy falling after reports Q4 earnings miss on revenue and fallen pretty hard there, down about 5%. Company saw a 43% decrease from the prior year, saying it was mostly due to lower product revenues. So this this one's interesting. We do have the CEO here saying in a press release, we're methodically taking steps to build upon our core capabilities, evolve the business, he says, model to achieve what he talks about as growth, profitability in the future. But investors obviously not convinced today. The stock was down. It's now lost about half its value, down nearly 50% in 2023.
Yeah, exactly. And this is even though the company, the stock taking a hit today, it did, yes, have that revenue drop and the revenue missed estimates. This, even though the loss actually came in better than estimated, it was a narrower loss than had been estimated for fuel cell. You know, the EBITDA loss, though, was bigger than estimated. So I guess that's what investors were sort of overweighting here. But we're going to talk a little bit more about this later on. And fuel cell is not a solar company per se, but when you look at a renewable energy sourced company like a fuel cell, not quite universally, but almost universally, we have seen a down year for that type of stock.
Yeah, it's interesting. I mean, often when you see a move like this move, a lot of analysts will kind of start poking around, kicking the tires, thinking, all right, well, a lot of the bad news is priced in. Not here. I mean, most analysts still on the sidelines, even after this kind of drop. Yeah. All right, moving on here. Stocks closing the day with solid gains across the board. Investors shaking off concerns about rising tensions in the Red Sea. Joining us now is George Mateo, KeyBank Chief Investment Officer. George, good to see you. I'm a broken record at this point. We're higher again, green. All three averages, George, finishing this trading session higher. Does this continue? Do we keep moving higher in 2024 as well?
Yeah, great to see you. Thanks for having me. Happy holidays. You know, I think Santa Powell came early this year, right? And we're all enjoying that year-end rally in spades. I think it does continue for a while longer, although we have to be careful about how far we go from here. You know, there's been a lot of good news priced in and a lot of ebullience around what happens next year with respect to rate cuts and those type of things. But, you know, frankly, we're still going through a transition economy, and it's a very nuanced economy. We think it's going to slow down a bit next year, but growth is going to continue, and that backdrop still sets up for positive earnings growth. So I think the all trends kind of point to some positive gains going forward.
And George, we were just talking about how we're looking ahead to PCE data on Friday. And we've all been, of course, obsessing over the inflation data for much of 2023. Is that going to continue next year, or what's going to be sort of the key economic data point that the markets are looking to?
Yeah, I think we'll continue to focus on inflation. We probably won't obsess about it as much as we have been because inflation is cooling. It's moderating, and that should continue. You know, the biggest component of inflation, of course, is the housing data, and those numbers are kind of coming back to earth from where they were. So we're seeing that kind of moderate to some extent going forward, and my guess is that's going to continue as well. But I think the bigger story for next year is not going to be inflation so much as it might be growth. And for that, I think we're going to have to focus on inflation secondarily, but instead we're going to focus on employment. We're going to focus on overall economic momentum. And I think the growth narrative is going to be a very good thing to watch. You know, the Fed has a dual mandate to fill. They have to fill things about price stability. They have to think about inflation, but they also be mindful of growth. And my suspicion is that they're going to focus more on growth side next year as opposed to just inflation.
And George, we've been trying to make sense of the Fed's moves here in 2024. Certain central bankers, policymakers, George, you've heard them coming out. Some of them, it seems like, trying to maybe push back a little bit, throw some cold water on the party. I mean, end of the day, George, you know, what do you expect the Fed to do next year? You know, when do you think they'll cut, and by how much?
Yeah, we only expect some modest cuts next year. I think the bigger question is going to be not so much how many cuts they put into the place next year, but the real question will be why. Why are they cutting rates? We think they might be cutting rates to take policy back to somewhat of a normal level. I think they overdid a little bit in 2023 and 2022 rather. But I think overall, I think if growth stays relatively sanguine and relative to upbeat, the Fed's going to cut back policy rates a little bit, but they're not going to be cutting rates aggressively. The only reason they would be cutting rates aggressively is if the economy was really in a free fall, frankly, and we don't see that happening. So I think the bigger question is not so much how many cuts they might put into place next year, but the reason behind the cuts is going to be more important than how many.
And so what are you thinking? And what are you thinking is going to be the trajectory of stocks as a result?
So we think stocks still have some upside to go from here. We still think there's some modest earnings gains to be had. I think the overall market backdrop is going to be somewhat challenged next year in the sense that we have an election year, and that's usually a case for uncertainty, some volatility, particularly in the first half of the year rather. And I think that's going to be with us for quite some time. So there's going to be a bit of a drag, maybe some uncertainty, but typically speaking, once we get past the election, stocks usually recover and move higher. So I think it's going to be kind of a choppy year next year overall. I think selectivity is going to be more important. And I think we really want to emphasize quality in this environment going forward above and beyond all else.
And George, when you say quality, what are you screening there? What are the financial metrics you're looking for?
Sure, sure. So we like companies that have really strong competitive advantages. Companies have good earnings momentum, earnings power, and margin power. We also like companies with strong balance sheets and also generate companies that generate a high return on invested capital. And so those reasons we kind of tend to focus on not just the Magnificent Seven. I heard at the beginning of the entry, you talked about the fact that this is not just an either or proposition, but an and proposition. We think there's room for both in a portfolio. That said, we want to be selective. So we own a few of the names in the big Magnificent Seven, but not all of them. We can kind of favor the Moz, if you will, the Microsoft, Apple, Amazon, and Alphabet of the trade. But the other ones we're not so much keen on. But that said, we do think the market's going to broaden out next year. And frankly, there's a lot of companies in the 493 that we think are well positioned to grow going forward as well.
And what are some of those examples, if you want to give them to us, or at least characteristics of those?
Yeah, characteristically, we like companies, again, that really have some strong balance sheets, some really strong competitive positions. We like certain stocks in the healthcare space. We also like stocks in energy right now, too. We think energy is an under-owned asset class and a sector in the market, too, that provides some stability in a rising rate environment and uncertain backdrop, and also provides some support to geopolitical uncertainty as well also. So those are some areas we focus on. We like some cyclicals as well. But again, companies that have really strong balance sheets is going to be more important, I think, going forward as things slow down a bit next year.
And George, in fixed income, I'm curious, do you see opportunities there, treasuries, corporates, munis?
Yeah, we do. I think, again, the notion is we want to focus on quality. That's kind of a continued theme of ours. We do think there's actually income and fixed income, again, as we've been saying. So bonds are back. And in a diversified portfolio, I think it makes sense to own both stocks and bonds. We do see some upside in bonds from here as rates continue to maybe trend a little bit lower. Again, focusing on quality is going to be very important, and selectivity is going to be very important next year. You really can't own everything. You shouldn't own the index. But I think there is really room for both in a portfolio right now. So we're staying balanced toward risk in general, meaning there's room for both stocks and bonds. And I would also note, I think within the bond market, I think investors have to prepare for themselves for some volatility. And frankly, that source of volatility might not be the things that the Fed can control. We've talked about treasury issuance and so forth being at record levels. That's likely to continue. So I think we have to be mindful of the fact that we might see some volatility in your bond portfolio again next year, as we saw much of the last 2 years.
George, thank you for that insight for both stock and bond investors tuning in. I know they appreciate it. Thank you for your time.
Thank you very much. Happy holidays.
You too. And coming up, it's been a rough year for the solar market, but there's some optimism for certain stock names in 2024. We reveal those picks coming up after the break.
FedEx earnings just out, and the stock is down 7.25% after its second quarter numbers. Second quarter adjusted earnings per share, $3.99. That is short of the $4.19 that analysts had been projecting. It looks like revenue was also below what analysts had been estimating, but really closer to in line, you could argue there. Also, we have to talk about the forecast here because there, FedEx says that it is going to see a little bit of a decrease in revenue, a low single-digit percentage decline in revenue year over year, had been looking for flat revenue on a year-over-year basis. That's for fiscal 2024. Again, it's reporting its fiscal second quarter today. So those disappointments are what is pushing that FedEx stock down here as we look through the release and try to suss out what exactly is going on.
Yeah, and it was, I mean, to take a step back too, this stock had been very strong performer this year. I mean, it was up more than 60% heading into this earnings print. And a big theme for FedEx has really been, Julie, the execution, this focus on efficiency, the kind of cost and productivity improvement plans they have in place. And also, though, I am interested in their guidance, the commentary they give on there. I would have thought, the consumer has proven resilient. So I would have thought maybe they would have relatively broadly more positive things to say about the outlook in the holiday quarter. So I think it'll be interesting to hear about what they have to say about that on the call. You can hear the CEO here in a statement saying, talking about 2 consecutive quarters of operating income growth, margin expansion, and he talks about that happening even with lower revenue. Yeah. Talks about the progress they're making again on their transformation as they navigate what he's calling here an uncertain demand environment. So more color and insight about what he means by that and going ahead will be critical.
Yeah, and the CFO's comments, John Dietrich, kind of echoing that, talking about demand continuing to pressure the top line, but he says we're pleased with our ability to deliver strong operating leverage and improved profitability. So this seems to be the message that FedEx is trying to send in the wake of these numbers, that in the face of some declining demand dynamics, they're trying to pull on the levers that they can to keep the business more profitable. But investors not buying that argument, at least not at the first blush. To your point, what they say on the call is going to be important here, more color that they offer, and we'll see if there's any alleviation of the shares falling here.
Yeah, I mean, I also, I think it'll be interesting to hear on the call, given that environment, what kind of pricing power do they think they have? Not just now, but looking ahead. Also, remember Yellow going bankrupt? I'd be curious to see whether, have they been able to continue kind of meaningfully capitalize on that as well? That's another interesting thread.
Yeah, definitely. It looks like also the ground unit did have some improvements on volume and price per package, to your point about pricing power. So we'll continue to dig into that, and we will be listening to that call. Switching gears here, it's been a rough year for the solar market. The Invesco Solar ETF, ticker TAN, it's gotten clobbered, and companies are struggling with high interest rates and sales cooling down. There is, though, some optimism for solar stocks in 2024, according to our next guest. Here to talk more about the solar outlook, Pavel Molchanov is Raymond James Managing Director. Pavel, it's always good to get your perspective on this. Indeed, it has been a rough year for these guys, in part because of higher rates, right? Because a lot of these projects, particularly on the residential side, are financed. We just had another company announcing in the form of Enphase today that it's going to cut workforce and close contract factories. Where do we go from here for the solar industry?
Well, I know it might seem surprising, but actually the amount of solar installations in 2023 is a record globally, including a record in the United States. So it's not a volume problem. It's in some cases more of a margin problem. And of course, for the stocks, as distinct from the fundamentals, it's also a question of valuation, right? So stocks can be down even if, the fundamental business trends are actually up. But look, this year, 300 gigawatts of solar will be installed around the world, which is an all-time high. 30 gigawatts in the US, also an all-time high. So it's actually not as bad as you might think.
At the same time, there have been some questions about accounting on the part of some of these companies, right? Because you talk about the cost involved, right? Maybe that's part of the issue, even if the volume is happening. but there's some questions about how some of these companies are accounting for some of the tax incentives, for example, that their customers are getting that they then are taking advantage of. Is this a problem that the industry needs to address a little bit better than it has been?
Tax credits in the solar industry have a long history in the United States specifically, going back to the Bush administration. So they're not new. What is new is something called Section 45X, which is this brand new subsidy for solar. Has been a big beneficiary of this, for example, as it relates to the manufacturing of products. So in other words, every solar panel you make in the U.S., you get cash from the federal government through a tax credit. So that is a new policy. But I think maybe the broader picture on what you asked is these are in most cases relatively small companies, fast-moving, dynamic, young companies in many cases. Yes, there are some accounting restatements. This is always annoying when it happens, but in the grand scheme of things, it's hardly the end of the world.
Gotcha. I mean, it might not be the end of the world, but it might be the end of the line for one of the companies you cover, and that's SunPower, which issued a going concern notice this week. Do you think they are going to go out of business? I think you still have an outperform on the stock, if I'm not mistaken, and it did rebound today. And what's the future look like for that company?
The going concern statement as a regulatory matter, it simply means the company needs to raise some capital within the next 12 months. That was never a secret in this particular case. There are other companies in the clean tech landscape. Plug Power comes to mind, for example, that also recently looks good, but it only tells us what people already know. Yes, additional capital will need to be raised. Do I think SunPower?
And are they going to be able to raise that capital, do you think?
Absolutely not. In this particular case, SunPower is backed by Total, the French oil company, Infrastructure Partners, which is one of the largest private equity firms in the world. Either or both of these are, what we like to call big brothers for a company like SunPower. And if needed, they certainly have the ability to put in some extra capital.
Right. Pavel, we got to leave it there. We're having a little bit of audio issues with you, but we'll have you back very, very soon, hopefully even in studio. Good to see you, Pavel. Thank you.
Bitcoin was trending all day long on Yahoo Finance as optimism grows over lower rates and the eventual approval of a spot Bitcoin ETF. Yahoo Finance executive editor Brian Sozzi sat down with Coinbase CEO Brian Armstrong and first asked him about his outlook for crypto in 2024.
Well, we really believe that crypto is the future of money, and that's already here. So it's not just a speculative asset class. People are now using it for all kinds of different types of utility. And we always believed that the industry would evolve in this kind of three pillars. We felt like it would start as an asset class. People would trade speculatively. Then it would become a new type of financial services with people doing stablecoin payments and commerce, remittance payments, earning yield on their assets, getting borrowing and lending with DeFi. And now, we're even starting to see this third pillar come online, which is crypto as a new type of application platform. This is what people are calling Web3. It's a new way for people to build applications in a totally decentralized way with decentralized identity, decentralized social networks, decentralized scientific research, and it's kind of the future of the internet. So it's much bigger than people, I think, realize, who are still thinking about it just as one asset class, and that's something that's exciting.
Since we last talked, I think it was the Goldman Sachs Tech Conference a couple of months ago, but just the prices of Bitcoin and other cryptocurrencies have gone through the roof. What do you think is driving that? Is it fundamental, or is this a good old-fashioned speculative move in crypto?
Well, you can always look back at these things with 2020 hindsight and try to make sense of it. But I think in this case, a few things. One is we've had a number of ETFs being filed by the biggest, asset managers and financial service firms in the world. And by the way, Coinbase has been named as, of course, the custodian in almost all of those, which is great. But I think the market is hoping and anticipating, as we are, that in Q1 we'll see some of those approvals come through. But more importantly, I think what people are reacting to this year is crypto is here to stay. I mean, think about all the bad headlines, the enforcement actions, there were CEOs going to jail, and yet crypto prices are up 90% year to date. And so I think the industry is kind of sending a very clear message here that this technology is here to stay. 38% of young people, if you survey them, they say they think crypto is the best way they have to have some new sort of economic opportunity in life. 90% of Americans are frustrated and upset with the current financial system as it exists. And so, yes, there's going to be ups and downs, but this movement's here to stay. And we need to send that message to Washington too, by the way, because I think not everyone there is aware of that.
The Bitcoin, that ETF, when do you see that being approved? And then once and if something along those lines gets approved, what happens? What happens to the Bitcoin prices? What happens to this industry?
Yeah, well, of course, I don't have any kind of inside information about when it exactly would be approved, but I think myself and others in the industry, we're all kind of hoping that might happen early next year. But what happens is big new pools of capital can now flow into these ETFs. There's certain pools of capital where their restrictions or bylaws don't allow them to, say, sign up to a Coinbase account and own digital assets directly, but they can own an ETF. And so these are where the largest pools of capital in the world, pensions, endowments, hedge funds, things like that, where they may be able to now move into the crypto space. Now, just owning a Bitcoin ETF is great. You're going to be able to get exposure to Bitcoin, but I also think it's going to bring a lot of people into the crypto space who may want to trade and own other assets. They may want to use crypto. They might want to earn yield on their assets or do institutional financing. And so I see it as a benefit not only for Bitcoin bringing more pools of capital, but also for Coinbase's existing business, Coinbase Prime for our institutions, Coinbase Retail for our retail customers. It's also just going to drive activity and awareness there. So I think it's all around good. And Coinbase has a place to play in the value chain here directly with customers, but also as a custodian for the ETFs.
You've been very vocal, Brian, on the need for regulation, whatever form that may be. I mean, do you think new laws would have prevented some of the blowups we saw in 2022?
Yes, I do. I mean, look, some of the rules are already clear that are out there. You have to follow AML, KYC rules, OFAC sanctions, and I think that part of the ecosystem is already pretty clear. But there's a whole bunch of questions which are not answered currently under the law about, just a great example is, are some of these assets a security or a commodity, right? Gary Gensler, when he was asked by Congress this question for Ethereum, which is one of the major assets, he couldn't answer that question. And so these are big unanswered questions in the space. Now, what has this done? I mean, it's basically driven a lot of the activity offshore to unregulated platforms. Those have had major issues this year, as everyone has seen, and that's caused a lot of consumer harm, including for American investors. And so when there's not a clear rule book, the industry is not going to be built in America. That's bad for the American economy, but it's also bad for American retail investors who are getting hurt by going offshore to these unregulated products. So ideally, the first case option would have been the regulators work with industry under the Administrative Procedures Act. They do a rulemaking process, publish clear rules. Everyone has to follow the same rules. That would allow the industry to kind of flourish in the US. Since that didn't happen, instead, we've had to kind of rely on the courts to create case law, to create some precedent. And we're ultimately, I think, going to have to rely on Congress to pass new legislation that would clarify, where does the CFTC and the SEC, what are their roles in this? So it's not having this turf war, lack of clarity, pushing the industry offshore. And the last thing I'll just say is I think the US is actually kind of behind on this. I mean, 83% of the G20 countries out there have already started work on crypto regulations and new laws. So the US is behind. There are 2 bills going through the House right now that have gotten bipartisan support in House committees. We're hoping those go to a full floor House vote early next year.
You're really plugged into the DC and the regulatory scene, Brian, as you should. I mean, it makes sense. You have to be up to date on this stuff. Do you get that sense that regulators are taking what Jamie Dimon said seriously on a potential ban of crypto?
No, I don't think that's serious. And it's actually strange because although Jamie Dimon's comments were a bit perplexing, internally at JP Morgan, they're actually advancing several projects working on blockchain and crypto technology. So there's such a large organization. I think sometimes the left hand doesn't know what the right hand is doing. But no, there's no world in the United States where 52 million Americans have used crypto now. This is 38% of young people believe this is an important tool for their economic growth in the future. I mean, it would be political suicide to be anti-crypto and try to ban it to that extent, right? And so I think next year we need to send a very clear message on that. There's an organization, standwithcrypto.org, which has been bringing together the crypto customer base in the US and trying to get to 1 million of them that will raise their hand next year before the elections and kind of say, all right, I really want to be a crypto advocate. I want to vote for pro-crypto candidates. I want to donate. I want to call my congressmen and representatives. So between the $78 million super PAC that came out yesterday, which is a huge step for the crypto industry, and this standwithcrypto.org grassroots movement, I think we've got a really big chance to send a message in DC.
That was our conversation with Coinbase CEO Brian Armstrong. And coming up, our conversation with the Chobani CEO. That's on the other side of the break.
Chobani is giving its business a caffeine kick, buying up the La Colombe coffee chain for $900 million. The Greek yogurt maker is setting its sights on the ready-to-drink coffee industry that it says is worth $3.8 billion and has seen 5% growth in the last 2 years. Chobani hopes the acquisition will complement its current offering of milk alternative and creamers. And the CEO, Hamdi Ulukaya, joins me now. Hamdi, it has been a while. Good to see you. Welcome to Yahoo Finance. Congrats on this big purchase. I know this is a very big event for you as a founder and for you as the business person and leader of this company. Why exactly did you make the acquisition, and why do you think now is the right time? Because you've invested in this brand a couple years ago.
Yeah, Brian, good to see you. I'm so happy to be with you. It's been a journey, and Chobani, and of course, it's been a journey for me personally at La Colombe. But coming to this point just before holidays has been dream come true for me. But I have been very, very patient. I have been part of both companies for the last, I would say, 5-6 years. Of course, from Chobani from the beginning. And I learned in this business, if you are going to start something to make it as meaningful player or do a disruption, there's no shortcut. You have to be patient and you have to build infrastructure and capability and brand and the trust. And you have to be going into a wild waters, competing and facing with large CPGs that has been around for a long, long time. The end of that patience for me is not to take my eyes off from yogurt category. And when Chobani performed really well, that's one. Innovate meaningfully, and I had eye on coffee category for the longest time, Brian, and I thought that this category was going to be evolved in all dimensions. And La Colombe has been around for 30 years, but made meaningful innovation, how this behavior is, changing along the way. And we entered coffee creamers category with Chobani brand about 2.5, 3 years ago. And that is related to a coffee category where people are purchasing cold brew in a large scale in supermarkets and ready to drink on convenience stores and other outlets. This category is very clearly has been changing in a very dramatic way. And La Colombe launched Draft Latte years ago, seeing this, officially fueling this. And it made a total sense to bring them together and use all the resources and capabilities that we both have at Chobani and La Colombe side and make this a meaningful combination.
You don't become a successful entrepreneur, Hamdi, without taking a few risks. And I'm going to choose two here. One, 2005, when you bought that manufacturing plant upstate New York. This, another risk-taking venture for your business. As a founder, how do you know when to pull the trigger on a big risk?
Brian, I haven't done much. I started Chobani, and I knew very early on this journey is going to be a very difficult one. And I had been offered some meaningful, return on my success along the way. And I said no, because me and the team, we had a greater goal. We wanted to make, meaningful change of how people are accessing the food in this country. And coffee, La Colombe, is one of the easiest decisions I've made. When I built the plant in Idaho, 2012, 2013, it was 1 million square feet. We had not sold a cup of yogurt at the time. It was a long shot. That could have gone really, really wrong, but thank God this became one of the best decisions I've ever made. La Colombe is very emotional for me, Brian, at the same time, because I've been involved for the last, 5-6 years. Of the people. I love this history of the brand. I love the people who are so crazy about making perfect cup of coffee every time. And they're so excited that with Chobani, this brand will be, keeping what makes it so, amazing, so unique, but expanding to making it available everywhere. That excites everybody. So to me, it was a very quick, easy decision. It was just waiting for the right time to be able to make it.
If I do not talk to you in 6 years, where is Chobani? Is this finally the public company you and I talked about potentially happening 6 years ago? Is it part of a larger brand? I mean, does this weigh on you at all as a founder of this big, successful food company?
Chobani can be a great public company, and that would be making if that happens one day. We do not have any pressure. We do not need need. We don't have need. I've always said it publicly. I would love my people who work for company for the longest time to have an access to what they have worked as their shareholders. That would be a good dream to come true. And if that day comes, I'll make that decision really fast. Today, really, I'm focusing on every day like I did last year is people, product, and what we can do as innovation and community work. Going forward, our journey will be a little bit faster because most of the work has been done. We're still very, very careful. But I'm really excited to take La Colombe, put it into Chobani's platform, and make it success and make it a lot shorter than the journey for Chobani. So 6 years from now, if La Colombe is not the #1 coffee brand in the country, I have not done my job right.
All right. Well, good luck with this integration. Congrats on the purchase, and hope to talk to you within a 6-year time period. Hamdi Ulukaya, founder and CEO of Chobani. Always a real treat to get some time with you. Thanks for joining Yahoo Finance. We appreciate it.
Good to be with you. Happy holidays.
Thank you so much. You as well. All right. Do stick around. Much more ahead on Yahoo Finance after this short break.
Southwest Airlines looks to be closing a long chapter in its labor battle with its pilots union. One report says the 5-year deal worth $12 billion. Southwest is the last carrier to strike a deal with its pilots. It's not a done deal quite yet, it seems. The union's board still has to decide whether to send the agreement to members for a ratification vote. So that's something that we are still watching here, but it looks more promising than it has been here. And, you know, this has been an overhang for a lot of the airlines to try to push these things through. And you could argue Southwest has had more overhangs than most. Earlier, we learned that the company, earlier in the week, we learned that the company was paying a fine related to some of the travel problems that occurred last year for people around the holidays flying Southwest.
Yeah, well, that was just an epic meltdown, stranded thousands of people.
Yeah.
But this one, it's interesting because they're kind of, I mean, they're peers to your point, Julie. So Delta, United, American, their pilots finalized their deals earlier. In some sense, too, it's interesting just to think about how, you know, it's a post-pandemic theme and trend as well. Like post-pandemic, everybody starts traveling again. People wanted to go out there, get after it, and they did. And that, of course, meant if you worked in this industry, if you were a pilot, if you were a flight attendant, you had some leverage to use, right? And so you could push for better pay and higher pay, better working conditions, and they did. And it sounds like they're going to get this deal done as well. We'll see.
Well, and it wasn't just the airlines, of course, right?
Right.
That
Oh,
had
yeah,
that.
for sure.
That's what's been so fascinating that we have both been watching since the pandemic is with the tight labor force, just the power and sort of a comeback of unions, right? Not necessarily the number of union members, which hasn't seen a big recovery, but the number of union activities, right? CNBC citing some research from Cornell University School of Industrial and Labor Relations saying there were 393 strikes this year involving more than 500,000 workers. And the number of strikes involving 1,000 workers or more was the highest since 2013, according to BLS. So, sort of anecdotally, we've been watching a lot of high-profile strikes. It's been the airlines, it's been Starbucks, it's been Amazon, the list goes on, and the numbers back it up that really there have been a lot of strikes.
No, to your point too, I mean, it was a theme and a trend we watched all year long of kind of labor unions flexing their muscle. It was from the UAW to Hollywood and everything in between. And a lot of that, of course.
Yeah, I forgot that little auto workers one.
That small one we covered just a couple times. But it's it's sort of like a lot of that was responding to obviously cost of living, how that rocket as inflation cools. You'll see how that kind of plays out in 2024.
Yeah.
Interesting. All right, time now for What to Watch Wednesday, December 20th, starting with the economy. New monthly consumer confidence data, which measures how optimistic or pessimistic consumers are with their financial situation, releasing tomorrow. December number expected to increase again, indicating a positive outlook on the economy. Moving over to the housing market, existing home sales numbers are coming out. Sales expecting to continue its slump in the backdrop of a continuing increase in home prices. And then on the earnings front, General Mills reporting Q2 2024 earnings before the bell. Consumer food giant is having a rough year. It's down about 20% in 2023, but looking to rebound with its Q2 report. And shifting gears to our own continued series, Yahoo Finance's Goodbye or Goodbye continues tomorrow, where we help you navigate the best moves for your portfolio.
And now it's time for us to say goodbye. But we've got the group chat next. Coming up, a firm's expansion into self-checkout kiosks in Walmart stores across the U.S. We've got more analysis coming up.
Welcome to Yahoo Finance's group chat. I'm Josh Schaefer here with Alexandra Canal and Praz Subramanian. And today we are starting with Affirm. Affirm has made a deal to bring their buy now, pay later offering to Walmart's self-service kiosks. You can see Affirm stock getting quite a bump on this, closing up 15% today. And so what is essentially going to happen now is Affirm, of course, the buy now, pay later service. Customers at Walmart will now be able to use that right at the kiosks. Of course, Affirm mainly usually used by customers online, right? You see that checkout option often on different online services. You go to checkout, you buy something, and it says pay with Affirm, and you can pay a little bit now, pay a little bit later. Interesting to see that now being able to be used in person when it comes to Affirm and Walmart.
Yeah, it makes sense to me considering one of the reasons why we've seen a resilient consumer is that they have these options like buy now, pay later. There's no fees, there's no deferred or compounded interest when you use these services. So it makes sense. We've seen it reflected in the data. Shoppers during Cyber Week, for example, spent $940 million using buy now, pay later plans. That's led to a boost in a lot of these stocks. You were just talking about Affirm. Over the month, that's risen over 70% when you think about those shares. So overall, I do think this is a smart move, especially for a company like Walmart.
You know, you mentioned that Cyber Week spending, you know, about $1 billion, but 42% growth from a year ago. So I was surprised to see that growth for people that want to do BNPL. I was surprised. I didn't know about the no fees and lack of deferred interest. I mean, that's good. That's good. That's a good product. I think, like, you know, the original BNPL was a credit card, right? And they're getting on fees every which way, late fees, high interest rates. Maybe this is the way to go for consumers who are a little bit pinched right now. You mentioned that stock. I mean, they survived the high rate cycle, and they're hopefully getting through that through next year, and the stock now taking off. But I mean, Affirm was
400% year to date.
Yeah.
Now, of course, when you zoom out to a 5-year or something longer term, 2 years, you can see it got crushed, right, in 2022.
Yeah.
And so for the stock to sort of have this bounce back recently, I think kind of gets to, our head of news, Miles Upland, got to this a little bit in one of our posts online today, but it kind of gets to the market moment a little bit, right, of a lot of these stocks that got crushed in 2022. Little news announcements, obviously a positive narrative happening with the firm here, but this could just be a normal news announcement on a normal day and the stock goes up 3 or 4%. But right now, with the short interest that you see in a firm and just the general market vibe, stock ripped 15%.
I would argue, I mean, Walmart, that's a big thing for in the self-checkout kiosk for that. I mean, that's a pretty cool option. Yeah, BNPL, they'll got to pay for 2 months, no interest for that time. Yeah, sure, why not?
Yeah, well, good option for shoppers, for consumers. This might also be welcome news for some consumers because I've been looking at mergers and acquisitions in the media industry as they seem to have fallen off a cliff in recent years. But there's a few rumors, few reports circling that next year we could finally see some deal-making activity. Bank of America, they predicted 3 names that could potentially merge together or sell off parts. Paramount, Warner Brothers Discovery, NBC Universal. Typically, it's those smaller players, but by and large, we've seen deal making really not just in media, but across the entire industry be on a downward trend because of high interest rates. You have a really shaky regulatory environment that's preventing that. But the hope is that at least in the back half of 2024, we're going to see some more deals. And if you think about the media space, there's just so much competition. There's a lack of profitability. It seems like this is inevitable. It's just a question of when, not if.
So you're saying there's a chance instead of having 10 streaming apps, I can maybe have 6 or 7?
Yeah, I think that's
all right. As a consumer, I'm happy. I'm sold.
What the future
I'm
is.
sold. That's it for me.
Well, you reminded me of yesterday's conversation about Amazon and what was the Diamond Sports? Yeah, so that's another. I mean, kind of not exactly a true M&A, but it's sort of a bankruptcy, right? But still, more consolidation nonetheless. You know, looking at big picture stuff. You know, we just saw, but you know, on the flip side, we saw Adobe and Figma call off their big merger, citing regulatory scrutiny. That's been a concern recently, right? Especially some of these bigger media companies, I think have to get through the whole process with the FTC and things like that. But you know, I think maybe big picture, you got wars, you got some instability in markets still. They don't want to do big purchases, so maybe there's companies are a little hesitant to splash out right now. Maybe that's not a bad thing. It's not a bad thing.
Well, valuation levels are certainly depressed. So it's a question of, do you want to sell your business at a cheaper price? Do you want to hold out, or can you have that option even?
Right, sorry, go ahead.
No, I was the second half of the year call stands out to me too, right? Because that's sort of in line with when you think about what people are projecting for, say, the IPO market, right? And just for more things to start happening.
Interest rates coming down too.
Right, we're talking about cuts. And so all of that sort of playing into each other, the second half of the year call kind of adds up with other things we're seeing in the market.
Yeah, lack of IPOs means lack of things to buy.
Right.
No new debt issuance, or maybe it's a new company to actually purchase. So, sticking with the media world, the big beef between Elon Musk and Disney's Bob Iger, Josh's favorite topic, is now spilling over into your Tesla. EV blog Electric reporting that Tesla removed the Disney Plus app from its EV's in-car infotainment system. Electric then clarified that Tesla said it would be removing Disney Plus from cars where owners never used the app before. So, it all seems a little petty here for Musk to, be upset about Disney spending on Twitter, and he said, I'm going to take you off of my Teslas. I mean, it's not nothing for Disney, but there's also 4 million Teslas out there, so it is a little bit of something there for them.
Yeah.
Bob Iger verse, Elon Musk verse. This is like the ultimate versus story, right? It's the two people we always talk about fighting other people, fighting each other. I think the story in and of itself, I wonder how much Tesla consumers care about what is offered on the screen.
Well,
how much do you care about how many different movie options you have in your car?
People were upset that Disney Plus wasn't. You weren't able to find it readily.
So I was in a Tesla recently, and I know you have one in your family. You charge that car up. What are you doing? In the charger?
Sure.
You're watching Netflix.
That takes
Amazon
like an
Prime.
hour to charge your car.
It could 20 minutes, even 20 minutes. You could watch an episode. So not having that option is something that is people actually use it.
Yeah, and it did feel like during the New York Times Steelbook Summit, which is really when this feud between Elon Musk and Bob Iger reached a fever pitch, it felt like Bob Iger was the scapegoat for all of the companies that pulled their advertising off of X. That's just what it felt like to me in that moment.
Right.
Like Musk was just expressing his frustration to all of those companies, taking it out on Bob Iger. To go that step further, if this is true, and pull the Disney Plus, I don't know.
It gets to a point that we made when we were talking about that too, of like, why go against Bob Iger and why go against Disney? To that point, if people do want content on their electric vehicle, as I'm thinking about it, why would you pull off one of the most popular brands in America?
It's petty.
Why pull off Disney and make your product worse, and then I can get another EV and my kids can watch Disney while we're charging the car? It just doesn't really actually make sense from a business perspective.
Yeah, well, we might not be able to watch Disney Plus in a Tesla, but I still have it on my TV, so everyone can come over and watch it there. But that'll do it for us today on Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your market action leading up to and after the closing bell. See ya.